Okay, we got to talk about this 50-year mortgage thing because apparently a lot of people don't understand how math works and never took Econ 101. I don't know if you know this about me, but I used to run a mortgage company in addition to, at one point, being a full-time real estate investor. So not only have I bought and sold and financed a lot of my own properties, I've helped many, many clients with that as well. So I feel like I have a unique perspective to share on the mortgage industry, especially in terms of how it relates to investing and overall wealth building and that whole, debt versus investing conversation. So one of the things that I've been seeing on the news and on YouTube is people commenting about what a horrible idea this 50-year mortgage is. And I want to share my perspective both as an individual investor, homeowner perspective, and then also in terms of macro socioeconomic, do I think it'll actually help with affordability, et cetera, et cetera. So on the individual side, I love it. And I'll tell you why. Because as a homeowner and investor, it gives you more options and spaciousness and opportunity. And I'll break that down for you. In terms of housing affordability, I think it's a terrible idea. And I'll share why on that too. So from an individual homeowner investor perspective, a lot of people use the example of a $400,000 mortgage, I guess, because that's about the average mortgage in the United States in 2025. So we'll go with that, and we'll use the numbers for a $400,000 mortgage. And they say, if you get a mortgage for $400,000 at 6% and you amortize that over 30 years, you will pay $863,352 over the life of the loan between principal and interest. You'll end up paying about $460,000 worth of interest over 30 years. But, and your mortgage payment will be $2,398. But if you were to go to a 50-year, first of all, it doesn't save you that much on the monthly payment. If you got the same interest rate, that would be a mortgage payment of $2,106. So it would be $292 less. That doesn't do that much in terms of affordability. However, if you take 50 years to pay that loan off at 6%, you will pay almost $1.3 million total, which ends up being, almost $1 million in interest. And they're like, isn't that terrible? Isn't that a scam? Oh my God, you're going to pay over $1 million for this $400,000 mortgage. And I'm like, do you not understand how math works? Do you not understand how interest works? Let me illuminate you. Of course, you're paying more in interest at the beginning of the loan because you owe more. And they talk about how in a 50-year mortgage, you'll be paying for 40 years before you've even paid half the thing off and start paying more depending on the equity instead of the interest. And I'm like, yeah. So let me walk you through this. Imagine that I lend you $100,000, okay, at 10% interest rate, just to make easy math. So $100,000 at 10%, let's say you just make interest payments for the whole year. Over that year, you'll pay $10,000 in interest, right? And then let's say at the end of the year, you have some extra cash and you're like, you know what, I'm just gonna pay $10,000 down on the balance of the loan. So now, instead of owing $100,000, you only owe $90,000, right? Well, the next year, if you continue to pay the interest, what's 10% of $90,000? Well, now it's only $9,000, right? You owe less interest because you owe less money, you've paid the loan back, and the reason you're paying more in interest in the beginning of the loan is because you owe more. And if you were to make a principal payment, it would accelerate what's called the amortization schedule. It would bump you further in that, and then every payment would be, giving more towards paying down the loan and less in interest. So when they talk about pushing it out and you're going to have to pay more interest, I'm like, I have zero problem with that. That just makes sense, because of course, with any loan, the longer you take to pay it off, the more you're going to pay in interest. That's just math. So people are like, oh my God, $1 million in interest, blah. Not a big deal. Not a big deal, because you're borrowing that money and you're paying interest on the money that you still owe. That's fine. It's fine. It's not a problem. Now, what mortgage means, it comes from the term death pledge. And what a lot of people say is like, oh, you want to be able to, pay the mortgage off before you die. And this is a way to create generational debt instead of generational wealth, because you might not be able to pay it off before you die. If the average homeowner, person buying a mortgage is 40 years old, will they even live to 90, blah, blah, blah. I don't have a problem with that either, because when you get a mortgage, yeah, it would be nice to pay it off. But one of the things that you're doing is you are locking in your cost of living. You're locking in your monthly payment. So you know what that is, and it's not going to go up. So let's say you get that mortgage, at $2,100, $2,400, whatever you decide to do. That if you get a fixed rate mortgage, whether it's 30 or 50, that payment does not change. That payment does not change. However, your income might change. Inflation will change. Like, as time goes on, the amount that you're paying, it's not the same dollars. You're paying in future dollars, which because of inflation is worth less. So depending on how long it goes and what your interest rate is, it's almost like they're paying you to borrow money. But what happens is you lock in that cost of living, and generally over time, not always, but generally over time, your income goes up and that payment seems like less and less of a big deal. Whereas, let's say you're renting, okay? Because you think this 50-year mortgage is a bad idea, 30-year mortgage is a bad idea, you don't want to have any debt, you're just going to rent your whole life. I get it that it's generally going to be cheaper to rent than own in the short term. Like when I was looking at the average mortgage payment versus average rental, and I mean, obviously this is going to vary a lot from area to area, but when I checked on it, the average mortgage is around like $2,300, $2,400 a month, and the average rental payment is around $1,750. So let's go with the $1,750. Let's say that that's what you're paying. You're paying less because you're renting. The most recent long-term rental increase on average was about 5.4%. Back in the day, it was more like 3%. So let's just round down a little bit and say 5%. So if you start off with $1,750 and it goes up just 5% a year, over 50 years, you're going to pay more than what you would on the mortgage. Let me just see, I wrote it down here. So in rent, you would pay $4.7 million. $4.7 million. So all of a sudden, paying, what was it, 1.2, 1.3 million doesn't seem so bad. And then, by the way, you are paying down that mortgage. So at the end of the day, you have equity in your house. Plus, there's no guarantee that property values are going to go up, but over a 50-year time span, it's pretty likely. So you have this asset that is likely appreciating. You're building up equity by paying down the mortgage over time versus just renting, which is ultimately going to be way more expensive in the long term. So when you factor in inflation, you factor in the idea that your income's probably going to go up over time, you're locking in your cost of living, and all of that, suddenly that looks better, okay? Now, let's talk about this small insignificant difference in payment, okay? If you're paying $292 less, and that's what, allows you to get into the property, great. But let's say you could afford the 30-year payment and you decide consciously to go with the 50-year payment instead. So now your payment is $292 less. What does that do in terms of opportunity as an investor? what if you were to take that $292 a month and set up an auto transfer into your investment account? So it just comes out of your account, just like another bill. So instead of like the larger mortgage, now you have the smaller mortgage, and then you also have this money going to investments. $292 a month doesn't sound like that much, but now we get that compound interest that everybody's freaking out about working for you instead. So $292 a month, let's say you grow at an average of 8% over 50 years while you have that 50-year mortgage. Now in investments, not only do you own your home free and clear, but you have an additional $2,331,505. So that insignificant difference in the payment allows you to accumulate an additional $2.3 million in change in wealth. So that's why I say that as an individual investor or homeowner, heck yeah, 50-year mortgage, sign me up, love it. I love having the options in terms of cash flow, because the mortgage on your property, that's often like the cheapest money you can get, because it's collateralized by your home. They figure like you're going to do everything you can to pay it back. Plus, in some cases, you get a tax deduction on the mortgage interest, which is one of the few deductions you can get if you're an employee. But even if you can't get that deduction, as you can see, in terms of locking in your cost of living and freeing up cash flow to invest, the 50-year mortgage would help you build wealth faster. So that I like. Now, let's talk about society, macroeconomic wise, and does it help with home affordability? From that perspective, I think it's a horrible idea. Horrible. I don't think it helps with affordability at all, because again, Econ 101, basic economics, supply and demand, right? Part of the reason that we're in a housing crisis right now is because we have more people that want housing than we have housing. Building has slowed down in the advent of the pandemic and supply chain issues, and plus the math doesn't math for builders to provide low-income housing. So they're building a lot more of these like luxury homes and such, right? So if you institute the 30-year mortgage so that people have a more affordable payment, what's going to happen is it's just going to drive prices up because of the same supply and demand thing. So when they can afford more on a monthly basis, they're going to buy more house, and off you go. Now it just drives prices up, and then we end up in the exact same situation that we are now. So from that perspective, I think that adding a 50-year mortgage will not help with housing affordability at all. And in fact, I think it'll hurt it, and I think it's a bad idea from that perspective. Now, let's talk about, well, okay, Penelope, it's easy to critique, right? But if you don't think the 50-year mortgage is a good idea for creating affordability, well, what's your plan? What are you going to do instead? Okay. There's a lot of things that we could do if we actually wanted to increase housing affordability. And I didn't come up with any of these ideas, but I had heard recently about how Vienna has like 60% of people in public housing, and it's not just low-income housing, it's also middle-income housing, and it's a very vibrant, lovely place, and wow, people have a place to live, which is pretty fantastic. So we could provide more public housing. I'm guessing a lot of people would not go for that one, but it's a possibility that would actually help. Another thing that we could do is limit who can buy residential properties. Like maybe we put some limitations on hedge funds and private equity funds and foreign investors gobbling up our property and driving prices up, because now homeowners are competing not just with each other, but all of these big companies that have boatloads of money. And I get that like BlackRock and some of these, I've heard that they're more buying, commercial places, but the fact that we have foreign investors coming in and private equity and hedge funds, it doesn't help. So putting limitations on that. And even on a smaller scale, and I hate to say this from an investor perspective, but limiting short-term rentals like Airbnb. Like San Francisco, near where I live, I believe the newest thing is that you can only Airbnb your own place. So you have a lot of people now who are buying and renting places to rent out as short-term rentals, which is like cool for those people. You know, it gives them a business opportunity to create passive and semi-passive income. And so I like that for them. But in terms of like greater good affordability, I don't like that. So we could put some limitations, like allow some investment like that, but maybe you can only Airbnb your own home, or maybe you can only have like one or two, or, you know, put some guardrails on it, you know, to protect people. So limiting in that way. You could also provide tax incentives and tax breaks to builders and investors for providing low-income housing. That would be an easy one, you know, and I know that some people might be like, oh, well, how could we give tax breaks to investors and builders for providing low-income housing? Would that not allow us to give huge tax break to tech billionaires? We got to protect the tech billionaires. But to that I say, you could do both. I don't know that you should. Like, do the tech billionaires really need more write-offs? But, you know, a lot of the tax code is designed not so much to collect taxes these days, but to influence the social and economic policies that you want to see. And so if you really do want to see more affordable housing, then giving tax incentives to investors and builders to do that would be a very easy way to go. You could also change the capital gains rules. For example, right now, if you want to sell your house, you know, you might have to pay huge capital gains taxes, which could keep people from selling, even though they might want to. Their kids might have grown, they might want to downsize, but they're kind of trapped because they'll have to pay huge capital gains if they sell. If you were to increase the capital gains exclusion limit or eliminate capital gains on the sale of your own home, people wouldn't be trapped, more of them would sell. That would create more inventory on the market, supply demand, there'd be more houses to buy, and that would help cool the prices a little bit. In the same vein, people are trapped because of having gotten lower mortgage rates. Like on our Benicia house, our mortgage is 2.99%. Like, that's pretty sweet. So I don't particularly want to sell or refinance and go into a 6%. Like, that doesn't sound fun. And so if you were to allow people to move their existing mortgage from one house to another, and maybe there's a qualification process, you know, like when I used to run the mortgage company and I would kind of pre-underwrite loans, one of the things you want to look at is the collateral. You know, you provide an appraisal. Is this a property that the bank feels comfortable lending on? So maybe you have to do a new appraisal, maybe there's something like that. But if you could take your low interest rate with you, again, homeowners wouldn't be trapped. They would be more likely to sell their homes if they wanted to, and that would help with affordability. So that's like five things that would actually work. The 50-year mortgage, I do not think it would work. I want to mention one more thing, because if you understand mortgages, you might say, Penelope, what about this? You left this out. And that is that in the comparisons I gave, and in a lot of these news stations, when they compare the 30 and 50-year fixed, they're comparing it at the same interest rate. And the truth of the matter is, if you went from a 30 to a 50-year fixed, you would probably have a higher interest rate. And in some cases, that would actually obliterate any savings on the monthly payment and completely defeat the purpose of extending your loan out over 50 years. So that is absolutely something to factor in. When I look at the difference in rates between 15-year and 30-year fixeds, there's a range, but on average, it's about 0.5% difference. So I would imagine that going from 30 to 50 is also about 0.5% difference. Obviously, it'll change from lender to lender. But if that's the case, if you really did plan to keep the loan for a long time, regardless of whatever loan you get, I don't know if you know this, but it's good to know. You can buy down the rate, meaning you can pay more fees up front to get a lower interest rate. So for example, let's say that on the 50 year, it's going to be 6.5 instead of 6. You could pay some more fees up front to get it down to 6. Again, it's going to vary by lender, But from what I've seen in my experience, usually about 1% in fees buys you about 0.25% to the rate. So you break even in 4 years. So if you really, really honestly cross your heart and hope to die, think that you're going to keep that mortgage more than 4 years, which we're doing in these examples of taking 30 to 40, 50 years to pay them off, then you could pay 2% to get that rate down to 6%. So in that case, in a $400,000 mortgage, you would pay $8,000 one time to get that lower rate. And that would save you about $100,000-ish over the life of the loan. So that is something that is worth looking into. So yeah, that's my rant on 50-year mortgages, affordability, whatnot. And this is the first video I've ever posted to YouTube of me just walking around sharing my thoughts. So let me know how this worked for you. Are you like, no, I'd much rather you be in your studio, like standing there instead of walking around panting? Let me know how this landed for you. And if you have any other questions about mortgages, housing, affordability, investing, let me know. Happy to create more videos for you. If this was helpful, tap the like button and hope to see you in the next video.